Good afternoon, everyone, and thank you for joining us for today's presentation. This is the CECL Journey, CSI CECL Bootcamp. Evaluate your progress on the road to CECL. And we have a very informative and entertaining presentation for you today, and we appreciate your joining us. If at any point during the presentation you should have a question, please feel free to type it into the box. It's located on the right side of your screen. We'll be monitoring that as we go, and at the end, we'll leave a little bit of time so that we can get to any questions that you might have. Now it's my honor to present Peter Čerpak to you. Peter has spoken on CECL before the RMA National Conference, CBank, and the American Bankers Association, and various other state banking associations. And he has been published on the subject in the American Banker, Bank Director, and the Independent Community Banker, among many other publications. So Peter, take it away.
Well, thanks, Matt, and good afternoon, everyone. Thanks for taking time out for an update on what's going on the CECL journey. And thanks also to CSI for hosting this and enabling us to be a partner in helping their bank community deal with the CECL challenge ahead of us. So let's get started talking about CECL. This particular webinar is going to speak to a little update on what's going on for smaller institutions as far as regulatory and audit expectations for CECL. And then we're going to talk about some special solutions that Ardmore and Argus have put together as partners with CSI to help you on your CECL journey. Not going to spend a great deal of time on the CECL rule itself. If you're not really familiar with it by now, you really should take a look at some of the foundational information that you can get on it, but I'll be happy to talk to you about it as well. So let me introduce, first of all, for those of you who aren't familiar with me, my name is Peter Čerpak. I'm a partner at Ardmore Banking Advisors. We are a full-service credit consulting firm that has been assisting community banks with credit risk management for over 25 years. We've been partners with CSI and CSI's banks for over 7 years, helping CSI and their banks with credit risk, lending, and other related concerns and consulting. We are a full-service credit risk management firm. We do loan review. We do credit risk consulting for banks who are under agreements or looking to upgrade their policies and procedures. We also help with credit data management, which is a very important point and a very important point of CECL as well. Argus Information Systems is our other partner. They develop software for banks. They actually are a global provider of bank compliance software. Ardmore did a joint venture with Argus in 2016 to develop out their global platform into one that community banks could use. And it's a very easy to use and effective program that's not over-engineered. And there, Argus is responsible for maintaining that and supporting it, and they do a great job. So that's my introduction. It's really a three-legged stool. It's CSI, your core provider who collects and hosts your historical risk data. They also securely transfer that data to Argus, the Argus Data Mart, that will hold your CECL data, and the software platform generates the reports and the analytics and calculations you need. Ardmore, our firm, we are your point of contact for support. We also help train you on CECL expectations and best practices in the industry. We are the people who help implement. If you buy the solutions that we're going to talk about this afternoon, we do the implementation function. So it's really a great best of breed approach to solving a CECL problem that we developed with our partner, CSI. So let's talk a little bit about I'm going to take 5 minutes and give you another high-level sketch of CECL. It is a principle-based rule. The current expected credit loss is what spells CECL. And when principle-based rule, the key takeaway there is it's a very subjective standard. It was designed to be that way, allowing banks a lot of leeway to approach being compliant with CECL in many different manners. The idea being that it's up to the institution to choose the best approach, to test out all the approaches, and to justify their selections of different processes within CECL. I should lead off by reminding everyone that CECL is not a regulation. It is an accounting standard. So that's important because that helps explain why you don't get a lot of feedback from your regulators on CECL. Their job is to enforce GAAP, or general accepted accounting practices. So that's why they enforce CECL. They also like the concept that it's proactive. The idea is it allows you to reserve if you see troubled times coming ahead or recognize signs in the economy or your portfolio that you may have problems. Under CECL, you can actually reserve for that. Under the current incurred loss model, you can't. So the regulators like that idea, but again, this is an accounting standard being enforced by them. Life of loan is a key concept, or LOL, as we like to call it. This is the concept that the basic change is that under CECL, you have to reserve for all of the potential losses for the asset at the time it is booked for its entire life. And life of loan, creating a life of loan calculation is one of the more complicated pieces of CECL, particularly for smaller institutions, as we'll talk about it. Projections include reasonably supportable economic projections. And the reasonable supportable is pretty important because reasonable supportable actually is subjective as well. What is reasonable and what is reasonably supportable is up to what you think is the right answer and what your regulators and your accountants think is the right answer. The period of time that you have to project your losses is also subjective. It's whatever you think, and it's up to you to decide how far can I project my economic conditions, how far can I project my portfolio's changes, and it's up to you to determine that and justify it. After you project your losses for what you think is reasonable, then you revert to loss history. So the way CECL works is you start with your loss history, your losses for the pools, you extend that to the entire life of loan, or in this case, life of the asset pool, and then you add a projection based on what you think is going to happen in the economy and how it'll impact your portfolio on a go-forward basis. And then once you've exhausted your projection period for the life of the asset, you would go back to the historical loss period. So one of the concepts that's spoken about a lot is the idea of how do you create either a Q factor, a qualitative factor, or a loss rate based on future projections. And one of the ways that's often talked about is to look at your portfolio and how it performed during similar economic conditions as you project. That requires a lot of data, and we'll talk about that as a next step. But probably the most important piece out of this overview is to say all of these very subjective decisions that banks need to make have to be justified, and the accountants and regulators have made it pretty clear they'd like you to justify it with data. One of the things that we like to make sure our banks understand is that if you choose to work with a vendor to solve your CECL challenge, you can't simply rely on the vendor to do everything for CECL. It's not a turnkey operation where you can say, okay, vendor, here's my money, go take care of this problem for me. Because the bank owns the risk and the bank owns the calculation, and regulators want to make sure the bank understands that and takes all the reasonable steps to be compliant. So there are many steps that you have to do on your CECL journey that a vendor cannot do for you. We can direct you and we can support you, but we can't necessarily do it for you. One of the places we always start is with a data assessment. Let's take a look at what data you've been recording from your loan origination, putting in your portfolio, putting into CSI. How thorough are you coding? Are you using all the codes available? How frequently are they coded? How consistently are they coded? What kind of controls are there over these codes? Because now these codes, credit risk characteristic codes, may determine capital changes for your institution. If you say this loan is commercial real estate and it turns out it was coded wrong, you could actually have a misbalance in your pools, which could now cause a capital difference. So this is where we always want to start, looking at the data you have and the quality of the coding. This is something Ardmore does for the bank as part of its services. And as we talk about our solutions in a little bit, we can talk about what that really means. Then once you've figured out what your data is, you still have to get historical information and figure out where to put that information. It's got to be in a secure, auditable location that you can call on to do the justifications and the slicing and dicing of your portfolio history. You also have to look at various economic indicators, macroeconomic indicators and microeconomic indicators, to determine what has happened, what do we think is going to happen to the economy, how does that impact my portfolio, what are the correlations between something like unemployment rate and delinquency in real estate, things like that. That's going to be more information you're going to have to manage. All of this has to be governed by good governance policies. That's part of, obviously, financial reporting. You have to have controls. So if you think you're going to take your data out of CSI, write a report, dump it into Excel, manipulate that, and then use that as your data source, you're going to have to document that whole process, and it may be considered too manual. So one of the things that our solutions do is take data directly from CSI, is directly transmitted through a secure tunnel to our solution. So there's no handoffs, you're not involved, your staff doesn't have to do anything to get the data over that's needed. You have to choose from many different methodologies that are available to calculate your loan loss. There are 5 or 6 different methodologies that are approved for CECL. Some of them may be better for certain asset types than others, and all that is still being understood. And to be honest, the larger institutions always take the lead on this, and that's unfortunate for the smaller ones because the resources required to test all these options, try them, see how they impact your portfolio is really difficult for community bank, as we'll talk about a little bit later. And you have to be able to figure out your projections, which we described, based on a life of loan calculation, and then translate that into Q factors or other adjustments to your loss rates. All of this has to be to create a viable, ongoing, auditable, repeatable, non-volatile ALLL calculation. So there's many steps to go. So data is the key, and you've probably heard this before. If you've joined me for other webinars, you've heard me talk about this, but I am going to just highlight a couple of points why you need a lot of information, data on your portfolio to do this properly. If you're going to create a life of loan, you really need to understand from the time that the loan is made until the time the loan pays off or is charged off or it becomes a TDR, what is the real average for that? Because you're really looking at an asset pool, the life of it. So you may have different tenors within that, different structures. So you may have, if you have CRE as one pool, you may have shorter term and longer term CRE credits in there. You may have credits that are at a higher LTV. You may need to look at payoffs, prepayments to create these things, and it's somewhat complicated. The more data you have, the more information you have to come up with your own rationale. It is also possible that your current collective asset pools are not risk-based enough. We work a lot, Ardmore does, with the regulators and the American Bankers Association, amongst others, to try to get to the regulators and get them to say some things to us about, can we use our current asset pools, or are we going to be forced to break them out? If we are forced to break them out now, we're going to have to go and look at changing our loss history, because it won't be relevant if we're changing our pool structure. We talked already about the need to correlate loss projections to economic trends. If you believe interest rates are going to go up by several hundred basis points in the next 3 quarters, when was the last time that happened, and how did your portfolio react? So you can justify changing your ALLL percentages. There's also new disclosures that are more complex, that have more detail. You're going to have to worry about those, and some of them look a lot like vintage calculations. You have to be able to prove data quality. In theory, you should have an entire market cycle of information so that you have data about the last time interest rates went up a couple hundred basis points. That's really a challenge for most community banks. We talked about controls, and the fact that the auditors prefer to see this coming from a central single data set as opposed to multiple sources being patched together. So data is really important. An example of how it could be important is on the left side. This may be your current pooling for your FAS 5 type, as they called them then. Collective asset groups, these could be your 8 pools. Well, on the right shows 26 pools if you have to break out these pools by different credit risk indicators to make them more risk-based, which is one of the things that the regulators are talking about. So you can see here we're taking 1 to 4 family, some of the commercial groups, and breaking them out to pass, substandard, and doubtful. We're looking at real estate and breaking them out by LTV bands because that's in alignment with the regulatory HVCRE rules. We're also looking at possibly individual consumer loans being broken up by credit scores, leases being broken up by times delinquent. There's a lot of different ways to do it. I'm not telling you you have to do this. Ardmore would never advise to a bank to do a whole lot of extra work just in case. We want to make sure this is what the regulators want. But we have to be aware of the fact that the best practices are still evolving. The good news for anyone who uses our solutions is the data is already automatically sent because we've already sat with CSI and they've created a data feed that will be sent directly for all of our clients. On a monthly basis, we'll get the feed, and it's got all of the codes that we know are required to do the calculations, as well as codes that would be nice to have, so for credit risk indicators. But GIGO still applies. That's the garbage in, garbage out. I've already done credit data assessments now for, I think, 5 or 6 CSI banks that have signed up. Maybe it's 7 now. And some cases, the fields are there, but the data's not in it, or it's not in it consistently, or it's not in it in a way that it can be used. So one of the things we do for those clients is we take a look at their data feed from CSI, and we give them advice as to what they should do to adopt better standards, enhanced coding, and more consistent coding. Now let's talk a little bit about what the regulators want. There was a webinar back in the end of February. I've already done a detailed presentation on this, and that is recorded and can be available to CSI bankers. But I did want to highlight a couple of points. This is for what they call less complex community banks. That is not a defined term. Less complex community banks is really, again, a subjective thing. When asked what criteria a regulator might use to determine that, their response was, we're not going to tell you that because we don't want to limit larger banks from being considered less complex if we use a size limit. And we don't want to tell a bank they're less complex. And I can tell you that I just worked with a community bank that has extensive nationwide lending using specialty lending types. They think they're relatively simple. I would say they are somewhat complex, so it's really subjective. But in any event, you can see the people and the groups that represented in this webinar, and their topic was practical methods for smaller institutions. So here are the takeaways that we took from this. The first one was they showed about 8 different ways to do calculations on spreadsheets. They said you can do the calculation on a spreadsheet, and that the math isn't necessarily always that complicated, but or you may not. So it's somewhat normal regulatory comment. Second of all, creating a reasonable and supportable life of loan estimate is very difficult and particularly challenging for smaller institutions who don't have a lot of data to work with, particularly historical data. The representative from the Fed, Joanne Joachim, stated that you don't want to keep your data in a spreadsheet. You can do the calculations on a spreadsheet, but they want the data in a controlled place like a data warehouse or a database or the core. The FDIC flat out said, you're not going to be able to do CECL with your own data. You don't have enough. So you're probably going to need some other data, peer data, or some sort of third-party data to augment what you have in order to come up with a reasonable, supportable CECL calculation. And in that presentation, there is no mention of how to do the Q factors or how to apply those assumptions into forecasts. Now, I just want to mention to you, I did this presentation, this exact slide, did a presentation for the Risk Management Association a month ago, and in that, a member of the Fed was there. I asked them afterward, I said, do you think I was fair in what I said during my presentation? And they said, yes. They said, I think what you said was factual. And when a regulator says it's factual, that's like a bear hug from a normal person. So I feel pretty comfortable this is what the takeaways were. One of the things they warned was that banks that have not been collecting risk characteristic data for CECL have to begin now, and they have to have a plan to improve. Risk characteristic data we're going to talk about in a little more detail, but essentially we're talking about characteristics of the loan, which is the origination date, the tenor for the contractual terms, what kind of industry it's in, the risk ratings, the credit scores, DTIs, the borrower financial ratios. Those are risk characteristics, risk drivers. You need to collect these and put them into CSI. And the outset, you may get somewhat of a pass in that you can do your very best effort, but your expectation is you'll improve over time. So you'll need a pretty rigorous infrastructure in place and start out with your best and then continue to improve. They believe there should be a cross-functional CECL project team because CECL impacts operations from a data standpoint and IT. It affects management because they have to sign off and understand the calculations. It affects credit. It affects finance. And even in a small institution, it can be a number of people. They said you can use a vendor if you want, but that the risk is on the bank to use a vendor. You have to validate the models that are used by vendors yourself. You can't rely on the vendor having it validated by a third party because that's not what the regulators want. They want you to understand and validate. It's up to the bank to decide if they want to use a vendor or not. And finally, no bank, no matter how small, is exempt from CECL. So sorry to say, for those who have been holding out that it would go away, it's not going away. A couple other things I found interesting. Bob Storch, who's the head of the FDIC accounting group, said that there are a lot of challenges for smaller institutions to doing CECL calculations. A couple of them include if you don't have any losses, how do you use that to establish a loss pattern for future projections? Or if you do have losses, but they're very sporadic, for 18 quarters, you have 2 losses in 1 quarter. How do you use that to create a projection for the next quarter? There are really no patterns to work with for loss curves. And if you have a small amount of loans in a particular segment, or you have a very short historical period to look at because they don't have a lot of data retained, it is a challenge. And a quote here from Bob in the presentation was, which typically means management needs to look for loss data from external sources. Finally, another comment he made was that if your historical performance information is from a different economic condition, it doesn't make sense to use it for your projection. So in other words, if you're in the depth of a depression and they bring up interest rates and you use that as justification, it doesn't make sense if you're in a good economy and they raise interest rates. So these are just some examples of the challenges that community banks have to face. So where are you in your CECL journey? Here we are in the middle of 2018. There are a number of activities that the regulators expect you to be doing, and if you haven't been examined yet, or you're going to have your safety and soundness, they're going to ask you what's going on in these areas. So we talked about CECL awareness across the bank. We talked about a credit data assessment, the idea of looking at what data you have versus what you need, creating a gap list and addressing that gap list through remediation, cleanup, scrubbing, and additional data collection. Thinking about a project plan, although it may be very high level at this point, how do you get from here to compliance in 2021? As well as looking at your own current financial policies and practices. In 2019, on the journey, if you're following this process, you probably have been building or buying CECL models by then, so you can test them. I mentioned there's an expectation you test all the different options and determine what's best for you and your bank. Then obviously you want to get into some parallel runs, fine-tuning your approach, looking at the capital impact, and be ready for 2021 production. One of the things that was learned on the international standard, IFSR 9, when that was put in place, was that banks spent so much time trying to figure out the best way to do stuff, they ran out of time to run parallel. And that's not really what you want, because that's when you find out where you need to tweak and change things. So the people on the phone today, this is where we have some questions. So I have a quick poll. One of the things we like to do is do a poll with our banks, and the first thing we always want to do is understand the asset size of the institutions on the phone today, so we can make sure we tailor our comments to that. So I'm going to throw out a poll to you. If you, it'd be great if you'd answer it for us, just so we can get a sense of the size of the institutions that we have, because size does matter when it comes to CECL. And one of the things that I find very frustrating personally is that so much of the information that's out there is for banks that are over $5 to $10 billion, or sometimes over $50 billion. And people who have a staff of quants, people who have extra staff, that's really not the audience that we're talking about here. So I'm going to close this up in a minute. I appreciate everybody taking time to register your bank size for us, so we know our audience. So we can show you that if you're interested. And so you can see the results. We're at 41% under 100 million, and just a few over 700 million. So again, an idea of the sizes that we're looking at. So following up on that, the other poll I'd like to do real quick for you now is to look at where you are on your CECL journey based on what I just walked through. Be helpful to us and hopefully for you to let us know where you are as far as, are you just sort of doing research, attending webinars and reading about it? Have you actually started talking about this within the bank? Are you changing your data management processes at all for CECL? Are you collecting more data? Do you have a plan, an implementation plan? So I appreciate those taking the time to vote. There's nothing wrong with being wherever you are on the journey. The key is to end at the right place. And one of the things you'll find is that Ardmore, there are solutions are there to help you on your journey as well. So I'm going to close this one out too and show you the results. And you can see that by far 2/3 of the banks online are doing research still. A few have formed a research committee, and a couple have either not started or are gathering data. So I can tell you that the regulators really do want you to get started, and you are going to have to explain to them what you're doing, your next safety and soundness. So we're going to go back to our presentation. Thank you for participating in the polls, and it looks like we're good to go. So I'm going to move on with the slides and talk about some solutions and problems for community banks like those on the line. So one of the things I want to talk about is, why is CECL particularly difficult for you, and what are the problems we're going to have to solve? The first one, I think, is pretty obvious, and that is that you don't have a lot of extra resource to go off and research and test a whole new methodology. It's not like in a larger bank where they can take some analyst and say, okay, we're pulling you off of production and you're going to go off and work on this CECL problem. Another example is that typically, and this has been underlined in my analysis, Ardmore's work with the current banks we have from CSI, only the most basic loan credit risk characteristic data is typically there. And we're not seeing much in the way of detailed credit characteristic data being stored, because simply you didn't really have to do it before. It was a nice to have. Well, now it's going to be a must have, I'm afraid to say. Typically, we don't see much automation in smaller community banks, not loan origination systems for commercial, not a lot of interfaces other than maybe a doc prep system. So mostly it's Excel, manual Excel-based reporting and analytics and financial tracking, and that's not going to fly under CECL. Or if it does fly, you're going to have to prove a great deal of control and documentation around how you can keep those spreadsheets from either being stepped on accidentally, being lost, or formulas and the like. We do not see a lot of electronic information being stored from the origination process, which is where a lot of this credit risk characteristic data lies. We see spreadsheets and loan origination documents on Word, and even loan loss and recovery information being kept off core and manual files. There's not much in the way of documentation or formal controls out of how loans get booked in the system, who makes decisions on the different aspects that are part of credit risk characteristic coding. So all that's going to have to be formally documented. I remember talking to someone in loan processing in one of the banks who said, yeah, I just got this loan from a lender and it says it's multifamily. And when I read it, I saw that it was a horse farm. So yes, it was multifamily of horses, but it was not a multifamily credit. And, that kind of thing is going to come to bite you under CECL. And someone needs to take ownership and document the process. Typically in a smaller community bank, you don't have any data warehouses, data marts, even databases of information. So you're totally dependent on your core or spreadsheets. So basically for CECL, that means you guys are behind the 8 ball. And I think we understand that, and our role is to try to help you get out from behind that. So let me conclude with a few minutes on solutions that we have for CSI community banks for CECL. And the one I want to focus on is the boot camp. This is pretty exciting, we think, because we don't know of anyone else in the industry that's partnered with a core system doing this. And let me explain. There are 4 steps to the boot camp. The first one is an expert third-party data assessment. Ardmore will actually look at your data. If you're a boot camp member and you sign up, we'll pull a file from the CSI data and we'll look at completeness, consistency, quality. We'll identify gaps in the data and gaps in the practices. We'll do that as a one-on-one, hands-on discussion with you. Ardmore, we understand CSI. We understand how their report codes and their control codes and their collateral codes work. We know what the limitations are, so we're not going to give you advice for things that you can't do. As a bootcamp member, after we do the assessment, we send you a report, and then we actually meet with you, typically over a GoToMeeting, where we walk through the report with you and talk about the results and what you can do or not do to enhance your processes. Typically, that results in a roadmap for you to follow to become more easily CECL compliant using your own data. We would encourage you to adopt new practices. One of the good things about CECL, I know I can hear the groans even though you're all muted, is that CECL does sort of force you to clean up your data management processes. In my view, a CFO or a controller or chief credit officer who's in charge of CECL implementation will take advantage of this under the umbrella of CECL to clean up some stuff that, it wasn't broken, you didn't have to fix it, but it wasn't real clean, it wasn't well documented. Now's a chance to enhance what you're doing from an information management standpoint. So that comes to the boot camp. You get that one-on-one data assessment and help in building a roadmap for enhanced data management. The second piece of the boot camp is the data mart. As I mentioned to you in the beginning, the regulators made it pretty clear. They don't want to see you managing your data on spreadsheets, other than possibly the calculation of the loss rates. So you need a place to put your information and build your historical records so you can use them to justify CECL and use them to help you with projections. So under the boot camp, you will get your own data mart. It's really an Argus data mart that is securely hosted. So CSI will securely transmit your data on a monthly basis, and it will start to build up that historical record that you need for CECL. It is automatic, so you don't have to, none of your resources are required to build up the data other than input, on the loan operation side. Obviously, that'll garbage in, garbage out issue, but technically speaking, this is all done automatically for you. The data mart starts to just accrue. We also have the ability to go back at least 3 years if you've been on NewPoint for 3 years, and we'll pull that historical data in automatically. If you are not a NewPoint bank and you're a Meridian bank, we're not going to have any history out there. They don't maintain it, but we can work with you to establish if you have trial balances that you used in your ALLL calculation to import those in as well. As soon as your bootcamp subscription starts, we can load the historical data and set up the go-forward data, and that will archive as long as your membership is active. Best practices for enhanced data management that we will help you with should be able to continue from that point on. So following with the idea of give your best effort now and enhance as you go. The third piece of the data mart is the resource hub, or the portal, as we call it. The portal is a peer forum, number one. So it's a place where bootcamp members can have a discussion forum and compare and share information back and forth about CECL implementations, experiences. You can understand best practices. It's an open forum, but only available to CSI bootcamp members and software, Argus software users that are from CSI. Well, in this case, they're very good peers. You'll find not only the discussion forums, but you'll find white papers there, fact sheets, recorded webinars like this one that you can listen to on demand. And also we'll use the portal to access a set of data quality reports, which we will generate out of the data mart, so you know what data is in there, and it'll also indicate where your gaps are, so you can sort of follow along as you start to fill in the gaps. When you're in the portal, if you have particular areas you want to know about and discussions come up, you can tag those and you'll get an email alert in your email telling you that there's been a posting on this particular topic, say it's life of loan loss calculation. You can also post questions to CECL experts, and members of either Ardmore or Argus or CSI will respond to that to help you along with your implementation. You also have the ability to control the use of the portal, so you may want to have several people in the bank look at it, but not be able to post. Others, that's really up to you. So this portal is pretty exciting, and it's a nice fit because one of the things we know is that bankers can learn from other bankers. The fourth piece of the boot camp that goes along with the data assessment, the data mart for archiving data, and the portal for peer sharing and resources is an exclusive set of training webinars, kind of like this one, that will be held just for bootcamp members. So this is going to be one of the last ones that I'm going to be doing for CSI banks that are not either software users or members of the bootcamp. This instructional series is meant to follow along the path of CECL. So for example, the fact that 68% of you, or actually more than that, over 70%, haven't gotten past the planning stage would suggest that it would be helpful for you to have some webinars on some more tactical things you should be doing now. And we will have people from Ardmore and Argus and CSI speak, as well as other industry groups. Some of these more tactical steps you should be taking, which we'll do on a quarterly basis, would be including data quality as a CECL issue and how to improve and address, different life of loan calculations and methodologies, projections and Q factors, loss estimation methods, best practices, because in a year from now, we're going to know a lot more than we know now as far as to what is considered acceptable and what is considered a best practice. So by having a regular set of updates and training instructional group sessions, you'll be brought up to date. So to show you sort of an architectural view of the boot camp, it all starts with your CSI data. And Ardmore will do an assessment of that as the first step to see where your gaps are and what you need to do to bring it up to snuff for CECL. Then the next piece of the boot camp is setting up your data mart, where we will get an automatic monthly archive directly from CSI into the data mart and start building up that historical single data set that the auditors and regulators want you to have. Then that from the data mart is a link to the bootcamp portal, where you can get through the portal the live group instruction webinars, the interactive peer discussion forums, the white papers, webinars, documentation, and reports on credit quality. So it's fairly simple. but effective way to allow banks to become CECL compliant in an affordable fashion. Just couple quick screenshots to show you what the portal looks like and some of its features, and then I'll wrap up with a description of how you can set up a plan to become CECL compliant using some of these tools. So you would log in to the boot camp. The home page is typically most recent discussions. From this, you can start your own discussion if you want, or you can join in a discussion that's going on. If you, for example, see on the screen, you could click on follow, and you could actually start following this and get alerts in your email if you want. You can see down here there are tags for quality, for CECL and data quality. There are also categories over here, which you can, if you want to just select the category and see discussions on those particular categories, you can do that as well. Here's an example of a person who's logged in and is looking at a discussion forum that's going back and forth between some bankers. Here is an example of particular resources that have been tagged by this person as theirs. These are things they want to refer to, and there are some postings and some white papers here. You can see that there's, again, categories and different ways you can tag these. This portal can be as complicated or simple as you want. If you just want to use it because you want to jump in and just see what people are talking about, see if you can learn something, all you have to do is log in. If you want to really play this thing with all of its features and functions, you can tag things, you can link yourself to different discussions, you can get alerts sent to you when someone talks about a particular category. It's got a lot of flexibility if you want it. For example, here's a screen of all the recent webinars, where if you want to, you can download these on demand and watch them whenever you want. Similar, here's an example of where I clicked on a category, data management quality, and here are the white papers that came up and the discussions that had that tag on it, data. Here's an example of a login page where you can set someone up and you can set up what kind of, they can do posts, if they can do discussions. If the bank wants to control this themselves, they can do that. This guy does not look to me like a CSI person. I think we probably would rather have someone who looks like this in our profile, but I'm not sure. My resources, again, list of different things that you can look at on demand. So one of the nice things about this is that if you join the portal and the boot camp is an annual subscription, you subscribe to it, you're immediately going to have a number of problems solved for you. You're going to have your data assessment. You're going to have a place to archive your information, including historical. You're going to have a training resource and a peer discussion area. But some banks may say, well, what about a full software solution? This is only a sort of a part of one. How does that work? Well, basically, you have the option to upgrade to our full Argus CPM suite. So if at any time you decide that you want to move from the boot camp to the full solution, you can simply upgrade, and you already have the data mart in place. That solution has 4 modules. It has a current ALLL calculator, so we can take your current ALLL and automate that, and that can be quite handy when you want to run parallel with CECL. It has the CECL calculations in it, so you can try the different calculations to see what works best, and you can start to run parallel once it's in place and there's enough data to run them. Also, it has 2 other portfolio management tools, an automated portfolio stress testing tool, as well as an automated credit analytic and reporting set. So our logic here being, if you're building up this data mart for CECL, you're doing all this work, you'd sure want to use that as many times as possible. It drives efficiency and justifies the cost. So we already have some banks who've gone ahead and just signed up for this directly. They said, I don't need the boot camp as much. I want to go ahead and buy the full solution now because I want to use the data now. I want to calculate my ALLL now, and I also want to use some of this other efficiencies gained from using an automated system. Other banks have said, I don't need this now, but I'm going to need this in 2020, or I'm going to need it in 2019. So we have that kind of flexibility. Also within the boot camp is the idea that if you don't want to upgrade, you can keep the data mart for as long as you want and keep paying the annual fee and building this up as an auditable central data set that's controlled, which is the kind of thing the regulators and the auditors want to see. But you could also take that data and just dump it into Excel to work with if you think you're going to use an internal model. So you're not locked into, if you have the data mart and you're in the boot camp, you're not locked into using our software package or any software package if you don't think you need it. However, it can continue to serve as your data mart. You also have the option to just end the entire subscription, in which case then we will actually give you back your data in an offboarding process, which I can describe if anyone wants it. So really to sort of wrap this up and leave some time for questions if there are any. The whole idea of this boot camp is to really create a scalable solution to help meet the CECL challenge for CSI community banks, to let people work at their own pace, but have the tools that they need to be successful in being CECL compliant. Because this CECL journey is a marathon, it's not a sprint. It's going to take a few years. You're in middle of 2018, got a couple of years to go before you have to become compliant. But there are a lot of activities going on, or should be going on. And you should get started now with the data assessment, with your data remediation, fixing the gaps, addressing your coding processes, putting together a project plan, identifying the resources that you need. This is all what should be going on in 2018. In 2019 is when a lot of banks will be doing the actual analytics and automation of their ALLL, testing the different CECL functions. And in 2020, you should be running parallel, understanding the capital impact, fine-tuning your approach. You may find that the boot camp is sufficient for now or this year and into next year, that you need to upgrade to a full solutions for 2019 and 2020 to get to that elusive 2021 live CECL. It's up to the institution to decide what's best for them, just as it is up to the institution to determine the best way to be CECL compliant. Our goal as a partner of CSI is to deliver to you best-of-breed solutions that can help you through the process. And it's really up to you to decide whether or not what's a good fit for your bank. But I can tell you that right now, the regulators want you to start doing something. And even if you don't want to use the boot camp and you don't want to use the CPM suite, you need to get started with the plan. You need to get started socializing the ideas around the bank of what CECL is going to do, and you need to get your data in order. Investment, always a good question. So for everything I described in the boot camp, which is the automated link to CSI data, for that automated transfer, the data mart, our data assessment, the portal and all of its functions, and the group training, it's $6,500 a year. If you wanted to buy the entire software suite from the get-go, you'll still be allowed to participate in the boot camp portal and training sessions. But as part of the implementation of the entire software package, you would get the assessment and the implementation by Ardmore and all the support. If you were to buy the entire software package, it would be talking about $15,000 for most banks in the range that are on this call. We do have a special in 2018 for banks who sign up for the CPM suite. That is the entire software package, is that we're taking the first year and taking $5,000 off. We do have some banks that have gone ahead, CSI banks, and bought the full package because they wanted to go ahead and take advantage of the CECL umbrella of activity to automate their credit portfolio management. We also have banks who signed up for the boot camp, so it's totally up to you. So where do we go from here? Well, if you think that one of these solutions is a good fit for you, and you think that it's something you're interested in learning more about, you can contact your CSI account manager and say, please hook me up with someone from Ardmore to talk about these solutions, or you can contact me directly. You see my information there. We do work both ways. It's really up to you. Sometimes we actually have CSI account managers sitting in on the presentations, and sometimes not. Whatever you feel comfortable with works. But we're pleased that CSI has selected us to be their partner for this. And hopefully you agree that our solutions are uniquely tailored to make smaller institutions successful. So this is a conclusion of the formal remarks. We're going to check to see if we have any questions out there. There is a place to put a blank where you can put questions in. Right now, the only question we have, well, there are two questions actually right now. One question is, can we have the slides? Yes, if you send me an email, I can send you a copy of the slides. That's not a problem. The other question was whether I thought that CECL was ever going to appear in a regulatory relief bill. I would say not. The reason why it's not is that, as I mentioned before, it's just not a regulation. So therefore, it's not on the radar right now of any agency to eliminate. It's really FASB, the Financial Standards Board, who's put this out there, and I don't think that they're really on the priority list for the administration at this point. So I don't see any other questions. If you do have questions or thoughts on this and you want some feedback, you can drop me an email. Me or one of the folks from Ardmore will get back to you with our thoughts. And again, we hope you'll be interested in joining our bootcamp community. Our goal is to have a dozen banks really by the end of the summer. We're halfway there, or a little past halfway there. We want to have a dozen banks to really have a reasonable community so we can start this interaction. So we're very eager and supportive of any banks who want to join us on this journey. Thanks a lot. Thanks for your time. And again, please contact me or your CSI rep if you want to follow up. Thanks and have a great afternoon.